Welcome back to the Deep Dive. Today we are taking a really close look at something that's kind of exploded onto the scene. It started as just, a button to checkout, but now it's really shaking up the whole world of consumer credit.
Absolutely. We're talking about buy now, pay later, BNPL.
Exactly. Klarna, Afterpay, Affirm. You see them everywhere now.
They're almost unavoidable if you shop online and popping up more in stores too. And, they seem simple on the surface, pay in installments, often interest-free. But the sources we've looked at, they paint a much more complicated picture.
Right. That's what we want to unpack today. Go beyond that surface-level convenience and look at the systemic ripples, especially this tension between getting what you want now and the hidden risks, particularly around debt that just isn't being tracked.
So just to set the stage, what is the standard BNPL offer? Usually it's that pay in four model.
All four, right?
Yeah, you pay about a quarter of the price upfront, right there at the checkout. Then the rest is split into 3 more payments, typically every 2 weeks, so over 6 weeks total usually.
And the hook is, if you make all those payments on time, there's no interest, no extra cost to you, the consumer.
Correct. That's the promise. Sounds great, doesn't it?
It does, and clearly people think so too.
Yeah.
You said it's unavoidable, ubiquitous even. The growth has been, pretty staggering, hasn't it?
Staggering is almost an understatement. I mean, just look at the U.S. numbers. It's not just steady growth. It's like a rocket launch.
Okay, give us some figures.
Well, get this. The top 5 BNPL lenders in the U.S., right, they went from originating about 16.8 million loans in 2019 to 180 million loans in 2021.
Whoa, wait, 16.8 million to 180 million.
Yeah. In 2 years, that's a 970% increase, almost 10 times the volume.
Okay, that's massive. That's not just a trend, that's a fundamental shift in how people are paying for things. It's completely sidestepping the old ways, the banks.
It really is. And it's still climbing. We're looking at estimates of, 86.5 million Americans using BNPL this year, 2024.
86.5 million.
And projected to hit maybe 91.5 million next year. It's becoming a standard option for a lot of people. I mean, some research shows nearly half of Americans have tried it at least once.
Half the country.
Yeah. And maybe more telling, about 11% are using it frequently, like 6 times or more.
So it's not just for, that one big splurge anymore. It's becoming routine.
Exactly. Integrated into just regular shopping habits.
Okay, the scale is clear. It's huge. So let's dig into the why. Why has this taken off so dramatically? Why choose this over, say, a credit card? Especially since many banks now offer installment plans, too.
Right. Well, I think it boils down to a couple of key things. First, it's just incredibly easy and instant, right there when you're about to buy something.
Frictionless is the word they always use.
Exactly. It's accessible, it feels affordable because you only see that first payment, and it's convenient. Click a button, instant decision.
And that instant decision, the approval rates are pretty high, aren't they? Much higher than for, like, a new credit card.
Oh, significantly higher, around 80% approval at checkout. That's way easier than applying for most traditional credit products.
80%. So most people who click it get it.
Pretty much. And that's by design, right? Traditional credit looks deep into your history, needs minimum scores, involves underwriting, it's slow. BNPL uses its own risk models, often focused more on, can this person make the first payment right now?
Simpler question.
Much simpler. And faster. They realize speed and ease beat the complexity of old-school banking for a lot of purchases.
Okay, so that's the mechanics. Instant, easy approval. What about the psychology? Who's really drawn to this? You mentioned younger consumers.
Yeah, definitely. Something like half of people under 40 have used these plans, and I think a big part of it is they're looking for control, or at least the feeling of control.
Control, as opposed to a credit card.
Right. Think about it. A lot of younger folks, maybe they saw their parents struggle with debt after 2008, or they've got student loans hanging over them. They look at traditional credit cards, that revolving debt, and see a potential trap. High interest, balances that just keep growing.
Yeah, the never-ending payment cycle.
Exactly. BNPL feels different. It's fixed payments, 0 interest if you pay on time. There's a clear end date. It feels more manageable, more certain.
So it taps into that desire for predictability, which brings us to this group mentioned in the sources, the self-aware avoiders. Tell us about them.
Yeah, that's a really interesting segment. Estimates suggest maybe 20% of U.S. households fit this description. They might have decent income, maybe even slightly better than average.
Okay.
But they actively avoid traditional credit cards. They see them as dangerous, maybe even, as one source put it, a product of the devil that got them or people they know into trouble before.
Yeah. Strong feelings.
Very strong.
Yeah.
So they're budget conscious. They like knowing exactly what they owe and when it's due. For them, BNPL is like a mental loophole.
A loophole. How so?
Well, it lets them buy things on credit, technically, but it doesn't feel like taking on scary, open-ended debt. It feels like a payment plan. Fixed, short-term, zero interest. It's debt packaged as convenience, almost tailored for financial anxiety.
Debt disguised as convenience. Okay,
Yeah.
that makes sense. So the consumer gets ease, they get that feeling of control. What about the other side? The merchants, the stores? Because if the consumer isn't paying interest, someone has to be paying the BNPL company.
Right, and that's the core difference in the business model compared to credit cards.
Credit cards make most of their money from interest
Right.
and fees.
Overwhelmingly, something like 80% of credit card profits come from interest charges paid by consumers. BNPL flips that. Their main revenue comes from fees charged to the merchant on each sale.
Okay, so the store pays the BNPL provider. Are those fees similar to what they pay for, like a Visa or MasterCard transaction?
Not usually, no. They're typically much higher. Credit card interchange fees are maybe, 1% to 3%?
Oh, on there, yeah.
BNPL fees charged to the merchant can average anywhere from 4% to maybe 8%, sometimes even more. It depends on the deal they strike.
Wait, 4 to 8%? That's a huge chunk. Why would a retailer agree to pay, say, 6% for a BNPL transaction when they could pay 2% for a credit card? That eats into their margins.
It does, but they pay it because, for them, it's a powerful sales tool. It demonstrably increases the chance that someone browsing actually buys something. That's called conversion rate.
Okay, so more lookers become buyers.
Exactly, and maybe even more importantly, it significantly boosts the average amount people spend in one go, the average order value.
Okay. So the thinking is, yeah, I pay a higher fee, maybe 6% instead of 2%. But if that customer was only going to spend $100, and now, because they can split it, they spend $150.
Precisely. That extra $50 in sales more than makes up for the higher fee on the total amount. It helps people buy things that maybe feel a bit outside their immediate budget right now.
It overcomes that price hesitation because you're not looking at the $100 price tag. You're looking at the $25 first payment.
Exactly. It makes the price seem smaller, more manageable upfront. So the customer gets the item easily, the merchant gets a bigger sale, pretty much guaranteed, and the BNPL company takes its cut from the merchant fee.
It's a neat little triangle of incentives.
It is. But that very ease, that frictionless design, that's what leads us directly into the biggest problem area, this massive blind spot it's created in the financial system.
Right. The black hole, as the sources call it. Let's unpack that. This is really the crux of the issue, isn't it?
It absolutely is. This is where the convenience starts to look potentially dangerous on a larger scale: invisible debt.
Define that for us. When we say invisible, what does that mean in practice? Are these loans not being reported to credit bureaus?
For the most part, historically, no. That's the key. For years, the vast majority of these short-term BNPL loans, the pay-in-4 type especially, were not reported to Equifax, Experian, or TransUnion.
So neither the fact that you applied for one, or whether you paid it back on time, or even if you missed payments, none of that showed up.
Largely, no. Some providers might report severely delinquent accounts eventually, but the routine activity, positive or slightly negative, invisible.
So let's picture this. Someone could, in theory, take out, say, 5 different BNPL loans from 5 different apps in a month, maybe $500 each. That's $2,500 in short-term debt obligations.
Right.
And if they then go apply for a mortgage or a car loan or even just a regular credit card, the lender pulls their credit report and sees none of that $2,500.
Precisely. That's the black hole. Lenders making decisions about larger, longer-term credit have no accurate way to know how much short-term debt a person is already juggling. It completely undermines the whole point of a credit report, which is to give a full picture of someone's debts and payment history.
Wow.
Okay.
And this easy, invisible credit, who's using it the most? Does the data suggest it's people who are already financially stretched?
Unfortunately, yes, that seems to be the case. The Consumer Financial Protection Bureau, the CFPB, did a big report in 2023.
Okay, what do they find?
They found that, on average, people who use BNPL tend to have lower traditional credit scores compared to people who don't use it.
Lower scores.
And importantly, they also tend to carry higher balances on their existing credit cards. They're more likely to be classified as highly indebted.
So it sounds less like a tool for savvy budgeting and more like maybe a last resort.
Right.
Or a sign someone's already struggling.
It can definitely be an indicator of financial fragility if you're using BNPL for relatively small purchases or especially for essentials.
Essentials, like groceries.
Yeah, that's a growing trend, apparently. Using BNPL for groceries, gas, utilities. If you need to split those payments into 4 installments, it strongly suggests you don't have the cash flow to cover basic needs right now. Or maybe your credit cards are maxed out.
That is worrying. And the sources also mention something called loan stacking. What's that?
Loan stacking is basically using multiple BNPL services at the same time, because Company A doesn't know you just took out a loan with Company B, and Company C doesn't know about either of them.
Because it's not on the credit report.
Exactly. So someone who's financially stressed can easily get approved for several small loans across different apps very quickly. They're stacking up these short-term debts.
And that sounds incredibly risky. You could suddenly have 5 different payments due around the same time.
Precisely, especially if you're using it to just get by week to week. You're financing today with a promise against next week's paycheck across multiple platforms. If anything goes wrong, your hours get cut, an unexpected bill hits, the whole thing can collapse like dominoes.
Okay, so if the users are often financially fragile and they might be stacking loans,
Yeah.
the default rates or missed payment rates must reflect that risk, even if it's hidden.
They do. The data we have on missed payments is pretty alarming. One recent survey found 41% of BNPL users admitted they'd been late on at least one BNPL payment in the past year.
41%, wow, that's high.
It is. And what's maybe more concerning is that number was up from 34% just the year before, so it suggests the financial stress among users might be increasing.
And when you miss a payment,
Yeah.
that 0% interest deal goes out the window, I assume?
Oh, yeah. Immediately. While getting the loan usually involves just a soft credit check that doesn't hurt your score, missing a payment triggers fees. Often hefty late fees, maybe $7 or $10 per missed payment.
And if you've stacked 5 loans, that's 5 late fees hitting you at once.
Right. It adds up fast. And some BNPL models might even start charging high interest on the remaining balance after a missed payment, so that free convenience suddenly becomes very expensive debt.
Okay, this picture of fragile users, invisible debt, loan stacking, high default rates.
Oh.
It makes sense why the traditional banks are getting nervous.
Definitely. And their nervousness, I think, comes from 2 places. One is, let's be honest, straightforward competition. The other is a more legitimate concern about the overall health of this system.
Let's start with the competition angle. They're losing business, plain and simple.
Absolutely. Every time someone clicks that Klarna or Afterpay button, that's a purchase that didn't go on a bank-issued credit card or didn't come directly out of a bank checking account.
And credit cards are a huge profit center for banks. You mentioned that figure earlier.
A massive one. Around 80% of their profit comes from interest. They made, what was it, a record $130 billion in interest and fees in 2022 from credit cards alone.
$130 billion. Okay, so BNPL is directly eating into that.
It has to be. Fewer transactions mean less swipe fee revenue for the banks, and crucially, lower credit card balances mean less high-interest revolving debt for them to profit from.
Yeah.
BNPL is basically diverting billions in potential interest payments away from banks and towards these fintech providers.
So, yeah, they're definitely feeling the pinch on the revenue side. But what about the other reason for concern? The systemic risk from all this invisible debt.
Right. This is the, perhaps, more honorable reason for their worry, though it still affects their bottom line, since they can't see the full picture of a consumer's short-term debts.
They're flying blind to some extent.
Exactly. They have to assume the risk's higher than what the traditional credit report shows. They can't accurately gauge how overextended some borrowers might be.
So what does that mean for you, the average person, maybe someone who doesn't even use BNPL? How does this affect your ability to get a loan?
Well, if banks feel they can't trust the data, they have to become more cautious overall. They might tighten their lending standards across the board.
You meaning fewer approvals?
Fewer approvals, yeah. Or maybe they approve you, but for a smaller credit line than they might have otherwise. Or they might charge slightly higher interest rates to everyone to compensate for this unknown, unquantifiable risk they perceive in the system.
So the invisible debt of BNPL users could indirectly make credit more expensive or harder to get for everybody else.
That's the potential systemic consequence, yes. The lack of transparency forces a kind of blanket conservatism on lenders.
Okay, it's a real ripple effect. So given this pressure, losing revenue on one side, facing increased risk on the other, banks aren't just sitting back, are they? They're trying to fight back.
Oh, absolutely. They couldn't afford to ignore it. We've seen a major reaction from the big players. Think Chase, Citi, American Express. They've all launched their own versions of BNPL or similar point-of-sale installment loan products.
Trying to beat them at their own game?
Essentially, yes. Or at least keep their own customers within their ecosystem. The main goal is customer retention or consolidation, really.
If you're going to use Pay in 4, they want you to use their Pay in 4 linked to your existing bank account or card, not go off to a separate app.
Precisely. Keep the relationship, keep the data, maybe eventually cross-sell you other products. But the big question is, can these giant traditional banks really replicate that super slick, instant, frictionless experience that made the original BNPL players so popular?
Yeah, it's a good point. The fintechs built their whole companies around that one simple checkout experience. Banks are trying to add it onto their massive, complex, highly regulated existing systems.
Right. There's a lot of institutional inertia. Can they be as agile, as seamless? That's the challenge they face. We're seeing this convergence now, where you, the consumer, might have multiple ways to finance a purchase right at the checkout.
A BNPL option, maybe your bank's installment option, your regular credit card.
Exactly. You get to pick your payment journey. And the winner might not just be about the interest rate, but about which button is easiest and fastest to click.
That focus on the user experience and the underlying data brings us neatly to the next big piece. How all this is forcing changes in the very way we measure financial health, credit reporting and scoring. You said the old FICO system wasn't built for this.
Not at all. It was completely unprepared for this type of product. FICO and similar models were designed around basically credit cards that's revolving debt and longer-term loans like mortgages or car loans, which are installment debts paid over years.
They had no category for these tiny 6-week zero-interest loans happening millions of times a day.
No. And the way the old systems tried to interpret it, if they saw it at all, could actually be negative for the consumer.
How so? That seems backwards.
Well, think about how FICO treats credit cards. Applying for lots of new credit quickly is often seen as a sign of risk. And having high utilization, using a large percentage of your available credit limit, also lowers your score.
Okay.
So if someone responsibly took out, say, 3 different $100 BNPL loans and paid them all back perfectly, the old scoring logic might see that as opened 3 new credit lines recently, possibly maxing them out immediately. Even though they were paid off quickly, the sheer activity could look like risky behavior.
So doing the right thing by paying it off could actually hurt your score, potentially.
Right.
While the debt itself remained largely invisible. That's confusing.
It was deeply counterintuitive and unfair. The system wasn't just missing the debt, it was potentially misinterpreting responsible short-term borrowing as a negative signal.
Clearly, that needed fixing, especially with BNPL becoming so widespread.
Absolutely. The sheer volume forced the credit reporting industry to confront this. They had to figure out how to incorporate this data, how to bring that black hole into the light, or at least understand what's in it.
And some BNPL companies started pushing for this too, right? Like Affirm.
Affirm was a key player here, yeah. They were the first big BNPL provider to make a commitment to report all their loan data, positive payment history, as well as missed payments to the major credit bureaus.
What was their reasoning? More transparency.
That was the public reasoning. They argued that sharing positive payment data helps consumers build credit, especially those who might be credit invisible or have thin files. They positioned it as a way to offer a more complete picture of creditworthiness, potentially using their own data and machine learning to assess risk differently than FICO.
That could be really beneficial for someone trying to establish credit without getting a high-fee credit card. But actually getting that BNPL data into the credit reports, that presented a technical challenge for the bureaus, didn't it?
Oh, a huge one. How do you integrate potentially billions of these tiny short-term transactions without completely overwhelming the existing credit report format? It's not like reporting a mortgage payment once a month for 30 years.
Right, and treating it like a credit card didn't work because of that utilization issue.
Exactly. So the industry, and specifically FICO, had to come up with a new approach.
And they have. There's a new model coming.
Yes. FICO announced a new scoring model, FICO 10T, expected to roll out, I believe, this fall. And the big news is it will explicitly incorporate BNPL loan data.
Okay. Finally acknowledging it's a permanent part of the landscape, how will it work? How will they count it?
The key change is they plan to treat BNPL loans as a specific type of installment loan, not as a revolving credit like a credit card.
Ah, okay, so that avoids the penalty for high utilization.
Yep.
Because installment loans don't work that way. It's more about, did you make the payment on time?
Exactly. The focus shifts to repayment behavior on these short-term loans. Did you pay as agreed? It's so, under this new model, that positive history should help build your credit score over time. It provides a path for BNPL use to be seen as a positive, responsible activity, assuming you pay on time.
That sounds like a much better system. It brings the data into the light and potentially rewards good behavior.
Hmm.
But does it solve the whole problem? We talked about incentives earlier.
Right, and that brings us back to the fundamental tension. This new FICO model relies on the BNPL companies actually providing the data consistently.
Will they? If this new transparency means that some users, maybe those stapping loans or struggling financially, suddenly look much riskier on paper.
Exactly. What if the new model, by showing the full picture, actually makes it harder for some current BNPL users to get approved, or makes consumers more hesitant to use the service because now it clearly impacts their credit score?
Could that hurt the BPR company's growth? Their whole model is based on easy approval and high conversion rates.
It absolutely could. So the big unanswered question is, if this increased transparency proves to be a detriment or a disincentive, as one source put it, will the BNPL providers keep sharing your data? Or will they pull back to protect their business model, prioritizing that frictionless experience over systemic transparency?
They might choose growth over contributing to the stability of the credit system if the two conflict.
That's the potential conflict, yes. They entered this massive U.S. consumer credit market. We're talking over $1 trillion in revolving credit, over $5 trillion in total consumer credit, arguing they offered better, honest financial products. But the honesty of full reporting might clash with the better experience of instant, easy approval for everyone.
That really captures the two sides of this, doesn't it? As we start to wrap up, BNPL is clearly innovative. It's forced banks to compete. It gives consumers choices.
Definitely. It's shaken things up, no doubt. It has pushed legacy institutions, offered flexibility.
But at the same time, its core design, especially the initial lack of reporting, allowed this significant hidden debt to build up, particularly among people who are already financially vulnerable.
It filled a gap, maybe, that banks were ignoring small, short-term loans. But the ease of access, especially when used for everyday essentials, comes with real risks that we're only now starting to fully measure.
So consumers now have more choices in that payment journey, BNPL, bank installments, credit cards. But with choice comes responsibility, more need for awareness.
Absolutely, more than ever. You have to be diligent, understand what you're signing up for, and crucially, understand your total debt picture, even the bits that might still be hidden.
Which leads us to that final thought for you, our listener, to consider. We see banks getting into BNPL, we see credit scoring trying to adapt, the system is evolving, but the fundamental question remains, are these BNPL products truly a step towards better, honest finance? Do they genuinely help people manage money better in the long run?
Or is it ultimately just repackaged debt, made incredibly easy, too easy to access, potentially making it harder for people to maintain real control over their spending and borrowing? What really stands out to you when you see that pay in 4 option?
Is the convenience worth the potential risks, the invisibility, the temptation? We'd argue that real financial freedom isn't about the easiest way to split a payment.
No, it comes from awareness. It comes from control. Knowing your full situation and making conscious choices based on that, not just on immediate gratification.
Control and awareness. That seems like the key takeaway here. Thank you for diving deep with us today on Buy Now, Pay Later.
Yeah, thanks for tuning in. Stay informed out there.
And if you found this useful, maybe share it with someone you know who uses these services. It's important information. We'll catch you on the next deep dive. Until then, stay aware and stay in control.